Hello, everybody. We're going to be looking at what is a tax. Well, when we look at the definition of a tax, not every single payment made to government is considered a tax, unless you're an economist, and that's not really the focus of our course here. This is from a law perspective. From a legal perspective, a tax is an involuntary payment made to government, and that is any level of government, that is coercive in nature, enforced by the state. The state has enforcement mechanisms that a regular individual does not have, including incarceration, loss of freedom. So the coercive nature is something that sets it apart from a regular payment, such as a regular contract dispute. And another characteristic of a tax is that it goes into the general coffers of a government. It can be earmarked for something like FICA, but generally speaking, when we look at it being something for defraying public expenses, the idea is that it is not given in exchange for a good, service, or right. For example, when you renew your driver's license, you pay a particular fee. That is not a tax. You are doing it in exchange for the right to drive on public roads. When you are paying for the right to exploration rights for a particular property that may be federally owned, for example, you are getting it for in exchange for something. So it would be an exploration right that you're buying. You're not paying a tax. Okay, so when we think about the purpose of tax, everybody understands the general notion that taxes are to fund government spending. It is to feed the voracious appetite of Uncle Sam and whatever the nickname is, the moniker for your particular state government or your local government as well. However, a lot of people don't really understand, or at least don't think about it, that these are also done to carry out specific social and economic policies. And that's done through the use of tax breaks, and it acts as an incentive for somebody to act in a particular way, such as education. When you think about the cost of education, there are specific education tax credits that are available. So, from a social policy, we're trying to encourage people to get an education. Yes, there's other ways they could do it, but that is how they've chosen. From an economic policy, we like people to buy houses and live in them. So we have various tax breaks that are aimed at owner occupied housing, including the mortgage interest deduction and the principal residence exclusion for when they sell the house. So that is social and economic policy actually in place. So when we're building a tax, what considerations do we have? Quite a few, actually. I want you to stop the video right now and I want you to jot down maybe 5 things that you'd have to consider when you're building an income tax. And then when you're done, you can continue the video. Okay, so one of the fundamental questions that we have in building an income tax is who's going to be taxed? Is it going to be individuals? Is it going to be the marital unit? Is it going to be the head of the household? Is it going to be the family? When we think about certain countries, it's very common to have multiple generations under one roof. So, do we tax them as a collective? Or do we just tax individuals? Do we tax residents only or do we tax citizens? The United States is the only country that taxes on the basis of citizenship and residency as well. But you, as citizens, are going to be taxed if you move abroad, which is not the case for any other nationality. You have to determine the rates that you're going to use and the amount of tax that you need to collect. Are you going to do it through a flat rate? Are you going to do it through a percentage, a flat rate that you're going to use, or a flat amount? Are we going to collect, I don't know, $100 from every person, or are we going to collect 17% of their income? Or are we going to use graduated tax rates? So if we do that, we have to think about what the brackets are. What are the various brackets and at what point does the bracket go up? All of these things are very nitpicky. So when we think about that, we really have to have an understanding of the actual rates and the brackets. Another fundamental question we have to consider is, what are we going to tax? Obviously this course is looking at things from the perspective of an income tax. So is everything income? What are we going to call income? Are there certain exclusions from income? Like gifts, for example. Are gifts going to be income? Are inheritances going to be income? Are windfalls? If I find a $10 bill on the sidewalk, do I have to report that as income? If I go to the casino and I win $1,000, do I have to report that as income? That's a windfall. If I make a bet with my husband and I win and he has to pay me $100, do I have to report that as tax? Does he get a deduction for it? I don't know. What do we have here? So all of these questions of what are we going to tax, these collectively are referred to as the tax base. So this is my lovely little drawing that I like to do every year. You can think of this as a bucket, or you can think of it as a balloon. I couldn't find a balloon I like, so I used the bucket. But when we put income in, it fills it. Okay. Exclusions are things that, well, you'd think they'd go in, but they don't. And they don't because we have a specific exclusion that somehow or another makes them bounce out of the bucket. And deductions are actually removed from the bucket. Okay, so collectively, this is the tax base, which we then times by whatever rate we decided, and that is going to equal the tax that is either collected or paid, depending on what side of the table you're sitting on, whether you're the taxpayer or the government. So this is fundamentally how we have to think of our tax system. It is a bucket or a balloon. The more things that you add in income, the bigger it gets. The more things you keep out of it, whether through deductions, which shrinks it, or exclusions, which doesn't inflate it in the first place. And that means that this page right here is one of the most important concepts that you need to learn in this class. Okay? If you look at this, you see rate. Rate tends to be the focal point for most politicians and policymakers, especially in an election cycle. Aren't we lucky? Okay, we talk about rates being too high. Rates are the cheeky little monkey in the room that get all the attention that shouldn't. The tax base is where the real monkey business actually goes on. Okay? So let me give you an example. If I earn $1,000 from my business and I earn $100 of investment income, I have earned $1,100. Okay? But let's say that we have developed a policy that is very similar to the policy that Kansas had 4 or 5 years ago, where all business income that is earned by somebody directly or through a flow-through entity is going to be exempt from taxes. So even though I earned $1,100, that $1,000 that I earned from business, I'm now going to remove it from the tax base. So I'm going to make it one of the exclusions. It comes out, which leaves $100 in my tax base. So let's use a 50% rate, mostly because I can do that math on the fly, and I think you can too. 50% rate applied to $100 of income means that we have paid $50 in taxes. Now, this would be a great time to get all offended and say $50, that is way, what a high tax rate. My goodness, that is ridiculous. Who wants to pay 50% of their income in taxes? Historically speaking, the highest tax rate that we've had federally in the US is actually around 92%, by the way. But who wants to pay 50%? That is just ridiculous. So when we think about that, it's like, well, that's true, 50% rate, that's not good. What do we do? Well, let's look at the bigger picture. We actually had $1,100 of economic gain, right? $50, is that 50% of $1,100? I think at this point, even the math challenged of you who wanted to assume the fetal position and cry as soon as I started using numbers, you should have realized that $50 is not 50% of 1,100. Okay? It's actually 4.5%. So when we look at the tax base, we managed to do all of this lovely little monkey business by taking things out of the tax base, by manipulating the tax base, not by manipulating the rate. The rate's a number, 50%. Okay? You can't really mess a whole lot with a number. But again, election after election, that's where the attention goes. It's like wearing the low cut blouse or something, trying to get everyone to stare at it. But the tax base is where the real shenanigans lie. Okay? So, timing. Timing is also an important consideration when you're building an income tax. What are the bookends that we're going to use in order to determine, like, what's the period that I am supposed to be calculating my income during? Is it a calendar year? Is it over a 2-year period? Do we do an average over a period? You know, is it, January to December, or is it March to February? I mean, you have to put bookends. Why? Because do we want to keep calculating income? I can't remember. I started my first summer job when I was 13 years old. I'm older than dirt now. Well, maybe not quite older than dirt. We still have faculty members who are older than me, yay. But, yeah, I'm at least as old as dust. I can't remember. Do I really have to keep track of all the income I earned when I was 13, 14, 15 years old? We don't want to do that from a policy perspective. Think of what a complete and total pain in the keister that would be. All the records we'd have to lug around. I've lived in freaking 3 countries. I don't want to be lugging those records from place to place. So having bookends to the time period definitely makes sense. So we use a calendar year when you are an individual. We use a 12-month period when you're a corporation, and you get to determine when that starts and ends. But once you have started it, you don't just get to willy-nilly play with it. Another thing for timing is, when is the tax due? In the US, here we have April 15th is the deadline, but you might have to make quarterly payments during the tax year. How do you calculate and report taxes due and owing? Well, here we've got a Form 1040. Does the government provide a pre-filled return? I like these. They do these in Europe, not all European countries, but some have started doing this. And basically, when tax time rolls around, the government mails you a tax return that is pre-filled with all of the information that the government has that's been reported for you. So basically, your W-2 wages would show up there. And you're supposed to look it over for accuracy, add anything that isn't captured there, and then you send it in. It's supposed to simplify it greatly. As a recovering litigator, I would look at that as say, hey, look at that. Here's discovery. They have just told you exactly what they know about you, and you can then plan accordingly. So, free discovery. But I don't believe the US is ever going to go down that road. But it's something to consider. So, we are at the end of this little micro lesson, and I hope that you learned something. Thanks very much.